Welcome to Zen and the Art of Real Estate Investing, one of the fastest growing real estate investing podcasts in the world. What if you could learn from experienced real estate investors? Find out what got them to where they are now. Get insight into their daily habits and take these insights to inspire your own growth. Each episode, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor and the founder of Streamline, a data-driven, investor-friendly, independent real estate brokerage located in Madison, New Jersey. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, this is the free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another episode of Zen and the Art of Real Estate Investing. And today my guest is Mike Zlotnik, the CEO of Tempo, family of funds and syndications. Mike is known as Big Mike due to his stature. He's tall, but more importantly, he is known for his personal integrity and for having a keen understanding of the financial aspects of successful real estate investing. It's because he has a bachelor's degree in mathematics. Let's get to Mike now. This is episode 284 of Zen and the Art of Real Estate Investing with my guest, Mike Zlotnik. Mike is the CEO of Tempo, family of funds and syndications. He's been a fund manager since 2009. He's been investing in real estate since 2000. He's also the author of the book, How to Choose a Smart Real Estate Investment Fund. And he has his own podcast, Big Mike Fund. Mike, welcome to the show.
Thank you very much, Jonathan. Pleasure to be here.
Yeah, I'm excited to talk to you and get your background because everybody's always so different. When was the first time that real estate kind of started to, play a role in your life where you thought, hey, this is going to be something later? Because I know you started in software.
Yeah, 2000, when I bought my first apartment here in New York City, it was primary residence. And so they say the first investment should always be your home.
Yeah.
Some people choose stocks and mutual funds, but we saved up and bought the first apartment for cash, as simple as that.
Oh, okay. Yeah. Well, why, when you did that then, I know you weren't thinking as a real estate investor then, but why did you decide to go cash on your first purchase? I grew up as a cash investor with a dad who was a cash investor, so I kind of knew it that way. But why did you choose to do that in 2000?
Good deal. You need cash. That's simple. So when I got
New York City, yeah.
short window, you have to close this cash, then you can refinance.
Yeah. That's fair enough. And that also goes to the tempo of the market. New York City, you're going to have, at least at that time, there's going to be a lot of bids, less opportunity. So the strong offers are going to be cash, quick close, not a lot of being a pain on the inspections and everything.
Exactly. Yeah.
Yeah. So once you bought that, did you start to see the scale of real estate, and how did you kind of transition to saying, hey, maybe software is not it. Maybe it's really real estate that's going to take me to where I want to go.
Yeah, that journey took only 9 years, very short window. I was passive for 9 years while maintaining technology career and then switch. But after I bought one, I bought a package of 8. And I kind of realized it's all awesome, but you don't cash flow. So when you buy deep, you basically buy future appreciation. But New York City, your cash flow is very light. Right?
Yeah.
So the bottom line is it's a great appreciation market, but it's not a great cash flow market. So it took me 9 years of just kind of thinking about what I really like to come to the conclusion, and 2009 was the time to switch.
Yeah.
But for a lot of professionals, it's difficult to make the transition because you have a great job, you have a great paycheck, and it takes a little bit of courage and circumstances to make the move.
Yeah, and I think you made a great point. It really is market dependent in terms of cash flow and appreciation. I grew up in New York. I live in New Jersey. I've always been an appreciation investor because I could be, which is fair. But I think that it really does matter because for somebody who's living in the Midwest, they may be able to get better cash flow, but much less appreciation, so much less scale. Do you think that it helped you focus more on the asset because the asset itself was really going to be more important because that's what was going to get you the appreciation in these markets, or the location of the asset?
I think I learned make the money on the buy. That's what I learned, right?
Yeah.
Everything I bought, I felt that I bought at a meaningful discount from what I could immediately flip it for. So my goal wasn't to flip, but just to get a good deal and purchase. Cash flow was a secondary concern. When you have a day job, the little bit of cash flow you would get from the investment is not really relevant.
Yeah.
So deep buy and then hold for long term. What I did know is that most of the fortunes in the world were made slowly over time in real estate.
Yeah.
Now you have, of course, the high flying stocks and the AI and all that stuff. But the good old book is wealth is made slowly over time in real estate, and it's not really made necessarily through cash flow, although cash flow, of course, helps, but through long-term strategy where you see appreciation.
Yeah, don't you think it's harder, though, for investors now because there's so much on social media about get rich quick, whereas at least when I was younger, sure, there were like, things on, they were on at 2 a.m. selling real estate classes. It wasn't always in your face. And now I feel like everybody's in this short-term mindset when real estate, as you just said, has always been a long-term game, continues to be, and is a tried and true way of making money in real estate.
I'll tell you this. I recently released an article and really have given it a lot of thoughts, comparing and contrasting good old value or deep value buy real estate versus Magnificent Seven and Bitcoin.
Yeah.
Right? Those are hot momentum investments. And if you're short term, it's difficult to go into a real estate. You really have to have a time horizon and you have to have a value investor mindset. So if you're looking for short-term gain, liquidity, continue to do what you do in whatever is working for you, but understand the risks. And the beauty about real estate, if you buy right, your risk reward, or there's another fancy term called asymmetric risk-adjusted return, is pretty healthy. And that's what we're looking for. I've always looked for that.
Yeah, I mean, I think that if that mindset can get people so far, it's just that I feel like they're trying to get out of, as you were saying, the maybe the 9 to 5 too early, when, hey, maybe you just like your career and you can do both. You did it for the 9 years until the assets accumulated enough where, hey, it made sense to do it. You built that runway. Do you think that's part of the problem?
Yes, the timing, in life is everything, in essence. So I did it for almost... I was an IT executive who software first, just rank and file, and then had a successful career for almost 15 years. There's no right or wrong time. It just has to be the right time for you. So many people continue to be passive their entire career, whether they're in software or they are pilots or they're doctors or dentists. As long as it makes sense for them, they don't have to switch and ever become real estate professional and focus all their time on this. I would say, I use this phrase all the time. And it's true for everyone and whatever they do. People should strive to be in their genius zone. And the genius zone is a combination of 3 things. Something that you really love to do. So if you love IT, if you love software, continue to do that. Yeah. I was a little bit burned out. The switch for me took place. And the other 2 elements is something you're good at and something that makes you money or you're very productive at. So the moment you feel like you're going to be in the genius zone, that's what you should focus on. For me, it was 2009 to start. I don't know. It's different for different folks.
Yeah, no, I get that completely. And I always think, people always ask me like, hey, when are you going to retire? They talk about the FIRE movement. And why would I retire? I'm in the zone of genius. Like, there's no reason to retire. Maybe I'm just working less hours because I'm more efficient and I have more people there. But this is what I love. Do you feel like that now with real estate as opposed to getting burnt out in software and IT?
Yeah, that's basically the feeling. I think we kind of great minds think alike. We're thinking the same thing, that as long as you can be in that, you never need to retire. What are you going to do? Retire, play golf? Or
I don't, and I mean, like, I enjoy activities, but I don't get the same kind of rush that I have when I'm building things or doing things that are going to create more generational income or can benefit other people. It's just not the same rush. Like, sure, golf is good, but it also takes 5 hours. I think, hey, how much money could I make in those 5 hours if I'm working? And that means it's more for my kids or more opportunities for myself.
I think there's a lot of similarity the way you and I think, and I have to say that I get the same kind of adrenaline rush and enjoyment from, creating value and making good investments.
Yeah. When did you make the transition, though, from your own personal investments to then building funds and syndications? Because there's usually a marker in there somewhere where somebody sees, hey, there's just more scale in a different way. But with that then comes getting other people's money into the mix as well.
2009. That's exactly when I made the transition. At that point, I was done. I was burnt out, tired from technology. and it was an opportunity to essentially start funding short sale flips.
Oh, okay.
It was 2008 crisis, and
yeah,
kind of gotten into funding. Original kind of business was to fund short sale flips. People were locking in properties on the short sale for $300,000 and flipping it for $350,000. Providing flash funding, transactional funding, whatever you want to call it.
Oh, so these were really just like quick bridge loans for basically wholetailing.
Yeah, between 1 and 3 days initially. And then we extended into effectively hard money loans from duration from 30 days to 3 months to 4 months to 6 months. It was anti-flip restrictions. People couldn't just flip fast enough.
Yeah.
So they had to hold. And then they had to renovate. So before you know, you get into essentially residential hard money lending business. And it was also pretty straightforward math. It doesn't take PhD in computer science or mathematics to do the basic math on LTV and some other underwriting.
Yeah. I think there's enough technology, even then, again, this is still 15 years ago, enough technology to, again, hedge your bets in the right direction. So you're not going to be a big miss. And that's what you want to make sure, that your money's taken care of. The asset's going to be worth more. So you're kind of set. And that was obviously a really good time because there was deals coming everywhere from all the foreclosures, which now I can't find as much at all.
Yeah, exactly. So we started managing our first fund then, and then we continued to evolve through hard money, then into commercial real estate, various strategies, and kind of fund the funds model, one-off deals. So it's all evolved gradually over time through the network of connections we built. And as people brought us deals, I'm doing a short sale flip, and then I'm doing a hard money loan, and then I got a wonderful commercial property here. You guys interested to work with me on this one? So it all came naturally through connections, networking, masterminds. So it's sort of we're not trying to. Like people ask us the question, where do you do business? And I tell them we do business wherever we have relationships.
Yeah.
So if you are in California, we'll do the business in California. If you're in Texas, we'll do business in Texas as long as we have a great relationship with you.
Yeah, that makes a lot of sense. But part of your philosophy over your career has always been networking and real focus on masterminds and building these relationships. Explain to everybody out there who's not as focused on those why it's so important. As we know, as you get up into commercial, everything is relationship based. But even in residential, the better relationships you have, the more deals you make and the more secure your deals will be, like you were saying.
Sure. So masterminds don't guarantee success. It's a great platform for a few things. One is educational. You learn best practices, who is doing what in the industry today, how they're doing it, what's working, what's not. It's changing over time.
Yeah.
Next is just networking. You get to connect with people, and in investment business, there's this phrase I use all the time. It's always in my head. You can't invest with me until you establish this, and I cannot invest with you until I establish this. And it's called know, like, and trust. Right? So part of the mastermind, they need to understand who you are, how you think, what kind of deals you do. And it takes time to build these relationships. But you got to start somewhere, and you start with know, like, and trust. Then you do some underwriting, whether it's debt or equity. So these communities are wonderful to build these relationships, to get you the right thinking, the right process, the right education. And over time, you get better, you learn more, and we all evolve through that process.
Yeah, and I've always said that the mastermind content is generally going to be okay. You're going to get that pretty much anywhere. It's not like someone's invented new content in a mastermind. Maybe if you're in short-term rentals, it's more specific, but it's not like they reinvented the wheel. But the people in the room with the same buy-in as you or the same motivation to get there are the things that could turn out to be partners for years. But as you said, it's part of networking to see who is a better fit for you, because not every person out there, just because they're in the mastermind, means they're going to be a great fit.
And I love this comment. People evolve and they grow and they change. I've had situations where first I loaned to folks for years on their fix and flips, and years down the road, they reached out, said, I made so much money. Can I invest in the deals? Well, what are you working with? What can I invest in?
Yeah.
So we've had a lot of that evolution, but you build relationships with successful business people. And as you do that, you learn on the way and you connect on on the way through the journey.
Yeah, and the better model, especially when you're talking funds and syndications, is build it up on relationships so you don't really have to take new money. A lot of people, when they tell me on their first syndication, they're like, well, there's money that we took then that we wouldn't take now. If you build up the relationships in advance and you've already done that, you're really just funneling in people. And then the referrals from those people are what I think scales it, as opposed to going on social media and trying to get a bunch of new people, which kind of just takes more time to get through.
Yeah, that's the good old world, relationship driven. I've had discussions with my team so many times. One warm referral is worth 100 cold leads on the internet.
Absolutely. Yeah.
Yeah, and I'll just add one quick point. So these relationships often bring us systematic and programmatic deal flow. Folks who work with us in the past and they have the next deal and the next deal makes our life a whole lot easier. Because people ask the questions, how many deals do you screen before you write a check? And I tell them, not that many. You would think you look through 100 deals. We don't, not in our business. We look through maybe 3-4 deals because they're coming pre-vetted from strong connections before we go and spend a ton of time underwriting. We got to go deeper in these deals, but at least they come through existing relationships and pre-vetted.
Yeah, and if you've built that two-way know-like trust, like you said, they know what you want. They know your buy box. They know what you're looking for in terms of a fund, even though if it's diversified assets. So they're really only going to present you because they don't want to waste your time either with something that's really close. So like you're saying, maybe you get 5 options. 4 could be pretty good. It's just about choosing them or maybe telling somebody else who you know, hey, this isn't a perfect fit for me, but this person is. And then there's another realm of relationships where you can transfer something over.
Exactly.
Yeah, I've always found it's interesting, though, when you start in residential because it's a little bit different on the small scale. But I think you see it as you go to more masterminds and you just see the people in the room. And then you hear some nondescript person that if you walk by on the street, you'd be like, oh, wouldn't think anything. And then they tell you, they own 1,000 units. And you're like, wow, okay, wait a minute. How did you do that? And then when you hear the story, it goes back to what we were talking about, slow and steady. Nobody ever got to 1,000 units by doing it overnight, right?
Yeah, there's an evolution. It's kind of funny. We'll go through lives. And I've had conversations with people now who have built these portfolios of many hundreds of rental properties. And now they actually want to deleverage that and sell a whole bunch of them and invest passively into some of our larger commercial deals. So there's no right or wrong, but I do agree with you. The person who looks like a schmuck on the street sometimes is the person who has the most money, and the person who is dressed up with the most expensive suit and is driving a very expensive car, maybe barely hanging in there. So
yeah. That you just described social media to me. I mean, especially in the real estate investing world, I think the people who are busiest as real estate investors over the last 30, 40 years probably don't spend a second on TikTok in their whole life. They don't need to. They're busy doing deals. Not that there's nothing wrong with social media. I like it. But I just feel like the millionaire next door philosophy is true. It's how my dad was. If he got out of the car, people are like, oh, is that the guy parking the car? It's like, no, my dad just wears shorts and a tank top. That's just what he wears. And I think that's where a mindset shift is different. It's not about the appearance. It's about really what you can do to connect and what you learn from somebody. And I always find it interesting at those things that it's always someone you wouldn't expect who comes out with that, oh my gosh, really? I didn't know. Or even you say like, oh, I didn't know that was you. You knew the name, never met them. And then you realize like that's them. I think that's a really interesting thing about the real estate investing world. It's big, but it's very small, and you can learn so much from other people. But again, we're not reinventing the way people are doing things. It's just small, subtle differences in how everyone does business. And then, as you said, the connections you make to do more business.
Yeah, I'll just add one comment on the connections front. So the way I think of real estate is you've got network, you got the capital. So our mission is to marry money and opportunity. But we also have to recognize market cycles and a number of other things over the years we've learned. It's kind of, if you're in a long game, you will see the good, the bad, and the ugly. You'll see cycles, you'll see successes, you'll see failures. And we all just need to keep learning. I mean, that's what makes it fun, is that if you succeed, you could pound on the chest or quietly enjoy your success. If you failed or a deal failed or something has gone south, as long as you learn and you're going to get better, it's like anything else. I don't think real estate is drastically different. It's old. That's one thing that the world and real estate go together. It's been around forever in essence. So that's the beauty about real estate. You really don't have to be on top of latest technology. You don't have to be on top of latest hot trends. You just have to understand the fundamentals, and that's what I like about it.
Yeah, absolutely. So at Tempo, what's your percentage in terms of funds and syndication? Do you prefer one to the other? Because building funds and building either just a one property syndication or even a multi is a little bit different.
So it varies. We're probably 50-50 today, but I would say that there's a significant recent trend to do one-off deals now versus funds. And some people have expressed interest in funds for their own diversification purposes.
Yeah.
But honestly, it's a lot easier to explain syndication, a lot easier to understand a syndication one-off deal. You got specific location, you got specific strategy, specific leverage, specific cash flow, etc. So today, I would say we are heavily focused on one-off deals simply because we want to be very confident that we're doing a great deal. Not a good deal, but a great deal.
Yeah.
And be able to tell the story to our investors, this is a great deal, and this is why. So for some folks reach out and still want to talk about funds, that's wonderful. But my personal preference, I got a lot more excited about deals because it's just, there's more excitement about it. Now, you have to be mindful that you still need to diversify. The beauty about the funds is diversification, but it's also got drawbacks and curses being in a fund. So I would say today, the more popular topic are one-off deals.
Yeah, I mean, personally, I started investing as an LP only last year, and all four that I'm in are all one-off deals. I feel a little bit more comfortable even with my experience because it's a product. Like you said, there's an address, whether it be 50 units or 250 units, I know it's there. I know what the asset is. That's the one thing I can focus on. For me, I haven't invested in funds, not because I haven't seen any good ones. It's just because it's a little bit too open-ended for what I'm looking for with my passive investment. But I can see why both vehicles work. Hey, it's Jonathan. I hope you're enjoying this episode with Big Mike. And if you like what he's throwing out there on this episode, even though we're only halfway done, I love to publicize other people's podcasts. Big Mike has a podcast. Guess what? It's called Big Mike Fund Podcast. You can find it anywhere you listen to podcasts and get his take on everything that he does. Can't wait for you to listen to that. But now, let's get back to the rest of the show. What asset classes are you doing for your syndications? Is it multifamily or more than multifamily?
So that's one of our strengths that we are very flexible. So at the moment, we see very deep value in multifamily, and we've done some deep value buy multifamily today because the market has gone through a cycle and valuations have been reset, right? We're also doing a deal right now in open-air shopping. That's been a contrarian play for many years. And the fear was Amazon was going to eat, or e-commerce was going to eat their lunch. But the crazy part is this. Open-air shopping has actually thrived. And you see this everywhere all day long. I just came, I have a family in Rochester, New York. And I was in Rochester, New York. It's a long drive from New York City last week and literally drove. And I look at the marketplace mall over there. It's an enclosed mall, and that mall is dead. And then you just basically drive 5 minutes away, literally 5 minutes away, open air shopping plazas next door. They are thriving. They're busy. They're loaded. It's kind of amazing. There's retail and there's retail. So a lot of people still love outdoor experiences. Service-oriented experiential retail continues to do well. And we find phenomenal deals in these type of deals because you could buy very deep. You could buy at a high cap rate. Certain asset classes, just very difficult to find deals. I just give you another example. I looked quite a bit recently into self-storage, and we love self-storage, but we haven't done that much. For some strange reason, it still trades a very low cap rate. Prices are high. I don't know what people are thinking about. They're still buying at a negative spread between the cap rate, what they're paying for the property, and the interest rate on their mortgage. And I look at these deals and I'm like, okay, that's wonderful, but you're not making any money on the buy. There's no discount. You basically are hoping you're going to be able to push rents higher.
Yeah.
Today, you can get into deals in certain less popular asset classes at a deep discount with motivated seller situations. And that's the whole game, is to find these opportunities. Of course, you could be a great momentum investor in real estate too. Data centers. If you are into AI, you think you're going to but you're going to pay a top price and they get low yields, but you think the world is going to get rebuilt very fast with massive investments into that, and that's happening, but you can't find great values. So I would say that today we are deep value driven. We're looking at what asset classes, locations, and obviously people who we partner with who can find great deals rather than any specific strategy or location. So as I said, open air shopping, multi looks great. We've actually looked at some really good industrial deals, but old school industrial, not new data centers. Those are too expensive. And then a number of other niche strategies.
Yeah. I mean, industrial is interesting to me, especially like you said, old industrial, because it can be repurposed for that new thing. You just have to, adjust to what you want to put in there. But there's also alternative uses, just as you said, like open air shopping still going, and light industrial has now gone more retail. I owned industrial for a 10% share for a number of years. And when we started, it was just basically like contractors and trucks pulling in, in the 80s. And then all of a sudden, in the 2000s and after, it was TV studios, exercise studios, because they didn't want to be on the main street in these towns. They wanted to be kind of a little bit off the beaten path. And everyone knew how to get there because there was Google Maps now. So it's not as hard to find something, which changes the landscape. And, that's the kind of fun thing, as you were saying, about real estate. You can look at it in a class like industrial, and it's kind of a different beast than it was 20 years ago.
Yeah, exactly what you mentioned. Light industrial seems to be very popular. You take bigger space, you chop it into 20 spots at 3,000 each, and before you know, you got a bunch of smaller tenants.
Yeah.
Also, we've seen triple net, single tenant, leaseback type of industrial projects. Yeah. So there's all kinds of opportunities. But what I do like about industrial and open air shopping, for example, is the contractual obligations to tenants, the credit quality tenants, which you can't quite do in multifamily and self-storage. So self-storage, you're dealing with a month-to-month rent. You go into multi, you got annual rents, maybe 2 year at max. And then you go open air shopping, you got a Starbucks 15-year contract, right? You know what the rent's going to look like the next 15 years.
Yeah, and your open air shopping is generally all vetted things. There's no mom and pops in open air shopping. It's all, conglomerates in there. So even if one goes out, it's not hard to bring another one in because they just want to go against their competition, a few stores down.
No supply. The crazy part has been so little supply in open air shopping. If you got a great location, it works. So for sure.
Yeah, and probably also because, as you were saying before, all of the inside malls are pretty much dead in general. So that space that maybe they're still using isn't getting as much value. So they're looking for something where they can recoup that value on the outside, where there's just going to be more foot traffic.
Well, they're redeveloping. I mean, old malls, there's certain really good uses. So, an example, again, in Rochester, they put IndyCar racing into a humongous, whatever it was some kind of a Sears-like big store, and they put a race car. You see pickleball courts. You see storage facilities. You have universities as basically took over a large amount of space, and they're building there's some custom procedures and medical stuff. But in general, there's reuse. And then there is sort of the good old malls that open air. I mean, not the enclosed malls. And restaurants, food concepts, good old discount retailers. Anyway, it's a niche strategy. If you're looking to invest, you definitely need to work with somebody who has deep expertise, because that's the field that is not like you don't see a resi investor buying houses and suddenly jumping into buying malls. They just roll over. It doesn't happen. You need a little bit more, let's call it institutional-like experience. What we really like, institutional-like sponsors are people who we work with, but not institutional size.
Yeah, I mean, that's particularly why I really like being a limited partner in syndications, because I can have exposure to multifamily or self storage or something like that without being an active operator. And I can trust the people who spend their whole time managing that deal. So instead of going out and getting a 12-plex and then hating my life because I'm trying to manage it myself, I can just get 50 units in an area where I'm interested in the area. So now I have part of an asset in an area, I'm connected to it, but I really don't have any of the management. It's been really an eye opener for me at this age. I think people will probably start doing it a little bit younger. But have you seen the same with your investors? As you were saying before, it's a lot of people, they're burnt out 200 single family homes. I mean, no one's going to enjoy that over time. It's just impossible to manage because you're not going to have them all in the same area. And then you go into something, you see the return, and it also goes up. And you can read the prospectus every single month. You can get a download on kind of what's happening so that if you do want to, though, get more personal interest, you could. But I find that I'm really enjoying the limited side.
I have to give you a lot of credit, love, and admiration for what you just said, because every time people invest, I tell them, listen, are you investing to learn or learning to invest? I just run this question because part of your investment journey is a learning experience. You have to invest and then read what's being produced by the folks you invested with and ask questions. And before you know, you will gain more expertise by being an involved and engaged investor, even though you could be just passive and do nothing. Yeah. So as much as you can enjoy that process, you will learn a lot and you'll get better at it.
Yeah, that's a really good point, because I found that even my, second, third, and fourth LP investments, I'm a little bit more targeted because I've learned more by reading every month and seeing what's happening, because they're all multifamily. So I'm seeing, okay, this is what I'm looking for. So now each time when I'm looking at deals, I wouldn't say I can go quicker, but I'm just more targeted in what I'm looking at. I'm looking at the debt right away. I already know the operator. I'm looking at the area, and if it's an area that I'm personally interested in, because anybody can create a very nice looking PDF. That's not going to do anything for me. For newer investors, it might. But yeah, it's been a really interesting journey for me. What are you seeing, though, in terms of your investors? I know you build this up over relationships, but when it comes to new referrals, what's the main reason they're coming to get into things that are clearly passive?
Yeah, it's a great question, and there's no right or wrong. We got plenty of high-tech people, doctors and other ones, and different ages. There's some people who are looking to retire and get more predictable income. Part of that theory.
Yeah.
I've had discussions with people who wanted to actually take on less risk. The bottom line, people go into real estate primarily because of predictability, but not to kid anyone, there's risk. There's risk in everything. Just to be very, very simple and clear about it. So it varies. The different circumstances and different conversations. Some of our existing investors looking for new deep value buys. So depending on who you're looking at, who you're talking to. Some folks, I'll give you a couple of really, really good use cases. Very recent, very relevant. I know this show will come out probably in a couple of months.
Yeah. Well, we're recording on August 4th, so everybody knows it'll come out in October.
Well, so we'll talk about this.
Yeah.
Very simple example. This was last December. I get a phone call from a very good friend. He happens to be a real estate professional who I originally met through one of the masterminds. The wonderful, wonderful guy. But here's what he said. Mike, I have so much money in crypto. I can retire many times over. This is the conversation. This is how the whole call went. Really? And I'm calling you, what do you got? So the roads are different. And we're talking about not a young guy. I would expect it from 30-year-old kid, but this is a close to 60-year-old fellow. And he just happened to buy crypto in large proportion at the right time.
Yeah.
So the conversation for him is diversification. He's got significant net worth built in that. And that got me thinking about the whole discussion about Bitcoin and about Magnificent Seven. A ton of people are sitting on heavily appreciated, no longer balanced, overweighted portfolios.
Yeah.
And some of them coming to realize that, why am I, these are big numbers. And if this thing corrects quite a bit, I'm going to have a really bad day. I'd rather take some chips off the table and go into what I believe is a lot more predictable. And on top of that, we're getting great deals in some of these multifamily deals or open air shopping. So my conversations with him have been incredibly easy, but this is one example of an investor who actually have come to a realization they have to do this. And I try to have the same conversation with other friends who have massive wealth in Bitcoin. And they tell me, Mike, it's in the bull run. I'm doing so well. I'm not ready to sell. I don't need the cash flow. I don't need this. So the truth, it depends. For somebody, they're right for it psychologically. Some other people, they're not. And no matter what I tell them, they're not going to look at our deals. I literally had a discussion with another friend. He bought Bitcoin when it was $50 a Bitcoin. And he probably put at least $250,000 into this. So I'm going to say, right? You can do the math.
Yeah.
It's an insane amount of wealth. And he doesn't need it. He doesn't want to sell. And he says, Mike, until volatility kicks in, many of these guys are not going to pay any attention. But when it does kick in, they're going to realize, well, wait a minute, I should have diversified a little more. So it's almost like you're telling them a story that nobody's paying attention to, but the theory is still very relevant. Rebalance your portfolio. Consider taking some chips off the table of Magnificent Seven or crypto.
Yeah.
Build your moat in real estate. And what's really amazing is some of these deals. I know you had Neil Bow on your podcast recently.
Yeah.
And he's yelling and screaming, buy now, buy now, buy now. It's the best time. I didn't listen to the episode. I just know Neil, right?
Yeah.
And he's right. Now is a phenomenal time to buy because you're getting such a great value. Whether you're at the bottom of the market or not, you just got to have conviction and courage to do this. That's all I'm going to say.
Yeah, I mean, I think when people look at the landscape of what they have as investments, it gets too comfortable because you've done so well in an asset. But I grew up with someone who told me to be diversified. I was investing in stocks at 15, real estate before I was 18. So, and I still follow those principles for the same reasons you're saying. I just don't want to have everything in one area. So even if you're in real estate, if you have everything in one city, you're not diversified. You know, you can say, well, I have multifamily and single family. Okay, but you're all in Chicago. Like, what if something goes wrong? Because we've learned especially with multifamily, it doesn't always go the same way. Those assets in multifamily that quote went wrong, the assets are usually still fine. It's the market that changed and the interest rates and how long they were carrying the debt and when they had to repurpose the debt. So it wasn't the asset that was the problem, but there's still ways, as you were saying, of just being a little bit smarter. I don't know why everybody wouldn't want to be diversified. I think it's that comfort in something that did well and not wanting to make a mistake. But I agree that I think they'll regret it later. It's also boring. I mean, as we were saying before, I get bored with just one thing. So I like to have a few different things that are making money, some with a little bit more risk and some with less risk.
Yeah, I think you have some great wisdom built over the years. And the only thing I can add to this is sometimes boring is great. It's like
I like boring
in that category. Although we have gone through a little bit of that volatility when the interest rate spiked and the market reset. But the bottom line, if you look at it from a long-term interest rate direction perspective, some people continue to say, well, the national debt to budget deficit ratio is out of hand, number of other concerns. On a cyclical basis, interest rates still too high and they need to come down. So there's no better time to invest in real estate when you expect the rates to fall. And we've heard President Trump put a lot of pressure, whether we're going to go down fast or slow, but we're going to go down, at least on the next couple of years basis. Yeah. And then we'll see what happens. And if we still see high inflation, real estate can work as a great hedge against high inflation with higher rent growth. And if we see slow inflation, the interest rates will be the tailwind falling. So we'll see.
Yeah, I agree with that 100% because the way that I look at it is I call it a double windfall. If you invest in a smart asset, as you said, you win on the buy, even if you're buying at whatever it is, 8%. And then even in 2 years, if it gets to 6% or 5 3/4, if we're lucky, you not only get the benefit of refinancing into a great rate, now you have appreciation on top of that. So you're getting that double windfall, but you only can get it if you do act now. So people focus too much on the rate and not the asset. I grew up as an asset hunter where I'm really focused on the asset. I'm not really worried about the tiny, like when people are in a small scale deal and they're arguing over, $5,000 over a 30-year loan. And you're just like, what's wrong with you? That costs you like $16 a month. You're going to lose an opportunity to get in. And you could have had 200,000 appreciation, where we are over just a few years.
Exactly. The big picture matters a lot more. So strategic thinking quite often is more important than small technical issues.
Yeah, and when you're bringing in LP investors for funds or syndications, it is really important to know their goals too, because anybody who's a short-term thinker is not going to be a good fit for funds or syndications as an LP.
But I'll give you a little bit of a contrarian view. I actually, we've connected to so many points, and I agree with your thinking so much. I recently had a discussion with one of our investors who literally said, well, I'm doing so well, but I don't really want a long-term horizon. I just want a good yield, good safety, and that's why, they're sitting in, let's call it treasuries and low-risk investments. And that's a wonderful conversation. And then we talked about this. Okay, so look at a 5-year horizon deal, right? And then you don't need to look at 20-year, 5-year horizon deal. You feel you're going to be around 5 years, and what happens if it doesn't happen? Is that going to make or break your situation?
Yeah.
It's like, no, I got a lot in liquid assets. Okay, so you could put a little more in less liquid. So you're not putting in the short 6 months hard money loan or 12 months liquidity, but you're getting so much more upside. We contrast return profiles of you put your money into a lending fund and you get 10, 11%, let's just say.
Yeah.
You get liquidity in theory within, with some liquidity options, but you're not getting massively higher yield that you could get as an equity on a deep value. So you get only 6%. But if you buy right today, a lot of these deals conservatively pro forma into very high teens or even higher. What happens if interest rates drop? So interest rates drop, what happens with these hard money loans? They have to re-roll them at the lower level of interest rates, so the yield will come down. But on equity plays, if you get into the right deal, you will get magnification effect of better cash flows and better appreciation. The interest rates fall. So it's all a matter of opinion, and I'm not trying to convince them to take the money out of treasuries and put it into a deep value buy deal, but we chatted a little bit about this, and then you start looking at conservative leverage, kind of what are you paying for the asset in terms of the cap rate versus the cost of money, and what kind of risk you're taking. If you're not taking a lot of risk and you have sort of very significant upside and still good cash flow, you may take your very short time horizon and be open to expand it to call it 4 or 5 years. It's just a thinking, but this is not a liquid strategy. It's just a very clear. If you need liquidity, keep it into public investments, right? Public market investments. Or, I'll just share one more thought.
Yeah.
The audience will appreciate this. We live in the age of AI, right? AI is everywhere. ChatGPT, Gemini from Google, many things. I use a thing called Perplexity. It's another tool. And I ask it a question: how much a prudent investor should have in real estate? Just a broad question. And then it did its own thing, and I don't know, a minute or two later, it spit it out 25 to 40%. There's no right or wrong.
Yeah.
25 to 40% real estate, the rest maybe stocks, maybe other things. So as long as individual portfolio has enough in these liquid investments where people could achieve liquidity, you could go a little bit bigger in real estate. So people have gone in real estate 80, 90%. Is there anything wrong? No. It's a personal risk tolerance, liquidity needs. So as long as folks have sufficient liquidity and they feel great about what they got, they can go way deeper. And some other folks are 10% diversified, and then they got their wealth in Bitcoin, or they got their wealth in Nvidia stock or whatever, right?
Yeah. Well, your Merrill Lynch manager, of course, is just going to assume that, hey, you're 80% in real estate, so you're not diversified, and then because they don't want you to buy real estate, and then you tell them,
they cannot.
Of course, but then you tell them, hey, no, of that 80%, 25's multifamily, 25's self-storage, 25's industrial, 25's open air shopping, and I'm diversified in 8 different markets, some in the Sun Belt, some in the Midwest. Like, that's true diversification. So you can have a diversified portfolio in any type of asset class. I mean, it's really, like you said, it's a tolerance of also, what do you like? I leave a lot of money in index funds for the same reason I invest in syndications. It's like almost protecting it against myself, but I have the liquidity to reach out and take money out of the index funds if I need to. Whereas I use LP investments now as a hedge against myself, so I don't go flip flip another house with this money, because it drives me crazy. I like the end result, but it's also an active thing that I don't want to spend my time on as much anymore.
Yeah, Jonathan, I concur. People use index funds. At least you don't have the temptation of buying and selling. You basically, it's more disciplined approach.
Right.
So
I have a little account for having fun, because again, but that's a risk tolerance thing. Index funds, low risk, good management. And then I have whatever I do in E-Trade just for fun, because I still like to play, because that's how I grew up. But, I guess it's everybody figures out their own strategy of what works. But, over time, as you were saying in the beginning, it changes. All of us change as we, either get older or job changes happen, marriages, kids, whatever it is. It adjusts your, portfolio assessment and how you would assess risk as well.
Agreed, 100%.
Yeah. So where's the best place for people to find you? Is it at tempofunding.com?
Absolutely, they can do that, right? Tempo as temporary, TMPOfunding.com, but there's a easier way to remember. Way easier. And I'm sure hopefully you'll put in the show notes.
Absolutely.
So I do run a podcast called Big Mike Fund Podcast. It is a little bit cheesy, and it's by design. It is not intended to be like a creating wealth show or something along those lines. It's just designed because people know me as Big Mike. I am 6'4". Maybe it doesn't look when I'm on video.
Yeah, right.
But I get up, I'm 6'4". I'm a big guy. People call me Big Mike, and I'm a fund manager. So bigmikefund.com. Very easy.
Yeah.
And if you misspell it, you didn't hear what I just said. You need to go to bigmikefund.com. I promise it's not a kinky site.
Yeah, right. There could be a big difference, but hopefully you've solved for that. Yeah, awesome. Well, it's been a pleasure speaking to you. I really enjoyed it. And it's nice to connect with people who do different things but have similar philosophies, because I really feel like it helps the younger generation see a little bit more long-term, because we've been in it for a while. We've seen the cycles, and we're also looking at it from a different lens of the short-term versus long-term.
I agree, and I'll just add one quick comment. So I grew up where people have talked about the wisdom of older folks. They've spent, their whole life developing wisdom. And a lot of younger generation don't have the same thought process. But this is the old world versus the new world. There's wisdom in the AI, there's wisdom in the kind of new technologies, but the world was still built on the same principles and concepts that folks who have been around longer over time have developed these wisdoms. And I don't know where we go. Maybe the AI tools will be the center of the wisdom. So people will not be asking, "Hey, Grandpa, what do you think about this?"
Yeah.
But they'll be asking, "Hey, ChatGPT, what's the wisdom in this situation?" Who knows, right? But at the end of the day, I call them a little bit older cats. We've developed sort of years of experience and a little bit of wisdom. So,
yeah, absolutely. And, AI is great. I've seen it do great things for me as I've learned to use it better and more efficiently for myself. But I still feel like that day-to-day experience of people you meet in a networking group or you meet at a real estate conference, those are the things that you can trust it more, like you said, because now it's a person in front of me who's done this as opposed to an AI recommending. Maybe it is great advice, but I'm still always going to trust a person more than an algorithm.
Back to the word wisdom. So I heard there are 4 things out there people talk about. Data information. That data information often falls into one bucket. The next bucket is knowledge. And then the third bucket is wisdom. So AI tools today definitely have data information and knowledge. Wisdom, that would require probably super intelligence.
Yeah.
And we're not there yet. So for the time being, there's still the opportunity to gain wisdom through conversations with guys like you and me.
Yeah, absolutely. Hey, we're still relevant. It's good to know. All right, Mike, thanks so much for spending the time. Appreciate it.
Thank you, Jonathan.
Yeah. All right. That was Mike Zlotnik. He's the CEO of Tempo family of funds and syndication. But if you want to find him the easy way, go to bigmikefund.com. I'm Jonathan Green. We'll see you next episode. Thanks for sticking around to the end so you can get a preview of who's coming up on episode 285 of Zen and the Art of Real Estate Investing. And it's my friend back for a second visit, John Bianchi. John is the founder of STR Search, and we go deep on a new project that we're working on together, what it takes to invest in upstate New York. We talk about small ball plays. You're going to find out what that is. And we just talk all things short-term rentals. If you don't know John, you actually might. He goes by the Airbnb Data Guy on Instagram. So follow him before the episode drops next time with John.